Hello, my name is Ian Slattery and I'm from the team at Zurich Investments. Firstly, thank you to Alan and all the team at MBC Financial for giving me the opportunity to speak with you today. I'm going to keep you for about 10 minutes. We're going to take a look back at what we saw from 2022 and a little bit more information about what we might expect to see from global investment markets in 2023. I'll also discuss some key investment principles to make sure we all stay on track with our long-term investment plan. So with that, I'd like to share my screen and just bring you through some of the main concepts of what we've been thinking about here at Zurich Life. Firstly, as we look back at the year that was in 2022, it was a poor year for equity markets. It is worth noting that equity markets hit an all-time high in the first week of January 2022 before falling rapidly in late January and into February as the Russian invasion of Ukraine materialized. As we move towards the middle of the year and for all the second half of the year, the main narrative was one of inflation. So how inflation was going to affect central bank policy in relation to the potential for higher interest rates and how those higher interest rates might affect global economic growth. So this took its toll on both equity markets and on bond markets, and it was a poor year for multi-asset investors. There were times of recovery, as we see in the chart, in terms of late March 2022, and most significantly in late June and into July 2022. But overall, it was a downward trend for markets in the last calendar year. Looking under the surface, so the chart I just showed you was global equity markets as a whole, but we do know that equities are made up of different sectors. So for example, we see the likes of energies, financials, industrials, and technology on the screen here. I think the big note on this particular slide is the outperformance of the energy sector, which is the large green bar on the left-hand side. Energy was up 57% as a global stock market sector in 2022, and that was very much predicated on the higher energy prices in relation to oil and gas that we saw as inflation gathered pace. It is fair to say that this was accentuated by the Russian invasion of Ukraine, which took both a massive societal, humane, and economic toll. But some of the inflationary pressures that we were expecting to see under the surface did materialize, irrespective of the Russian invasion of Ukraine. On the other side, some of the darlings of the stock market in recent years, like technology, consumer discretionary communications, were the laggards on a sectoral basis. And overall, we see a split in terms of the large divergence between the best performing sector of the year and the worst performing sector of the year. And just to continue the narrative of inflation, inflation was the big story of 2022. What I'm showing you here is the 10-year chart of US inflation. So US is the biggest stock market in the world. It's the biggest economy in the world. So it garners the most attention. The blue line is headline inflation, which is a wider metric, while the red line is core inflation, which strips out more volatile aspects such as energy and food. And the big story here is we see the two lines, broadly speaking, oscillate around the 1% to 2% for much of the last decade before they sharply rise on the right-hand side. And that is since January 2021 through January 2022 through to January 2023. However, you will note that the two lines, the blue more significantly, start to come down or fall off towards the end of this chart. And this is some cause for optimism as we look at the outlook for global stock markets. The reason that we have seen that inflation figure fall is the actions of central banks. When we talk about central banks, we're talking about the Federal Reserve in the US, the European Central Bank in the Eurozone, and the Bank of England in the UK. You can see here, this is showing the key interest rates for the big five or the main five central banks globally. And you can see the US has been aggressive in terms of the red line, the gray line is the UK, the Eurozone in the blue a little bit further behind. But these tightening of monetary policy, or by other words, higher interest rates, is trying to tame inflation and bring inflation under control, hopefully without causing a recession. And the other big reason that we've seen the inflation figures fall in the back end of 2023 is charts such as this, which is showing the volatility and the ups and downs of the European gas prices over the last 2 years. Interestingly to note that Eurozone gas prices or European gas prices are actually below a level they were before the Russian invasion of Ukraine. So the European governments have done a good job in relation to stockpiling gas. The milder winters helped as well. So a poor 2022 in relation to that kind of concept of higher inflation leading to higher interest rates, which manifests into fears of lower economic growth. However, some of those things may start to be under control, and there's a little bit more optimism as we look to the year ahead. There is value in fixed income potentially for the first time. I've spoken about equity markets already, but if I look at government bond yields, this is the yield or the income you get off the bond. You can see on the right-hand side of the chart, they are starting to tick up again after roughly 20, 25 years of lower bond yields. However, that upward movement in yields did mean there was a downward movement in prices in 2022, and government bonds did suffer one of their worst years on record. However, as we enter 2023 and when we look for the year ahead, there is some cause for optimism in potential opportunities that might be there for fixed income markets for the year ahead. Zurich is an active investment manager, so what that means is we make decisions about whether we want to buy certain parts of the stock market, sell certain parts of the bond market, and our asset allocation for us is the main driver of returns. So when we talk about asset allocation in multi-asset funds, it's the mix between equities and bonds, alternatives, property, and cash. In recent months, at an asset allocation level, we have reduced our equity content across multi-asset funds. So that again is trying to insulate that against some of the falls that we've seen in the back end of 2022. We've increased our geographical allocation to US equities. So again, as I mentioned previously, the US equity market is the largest in the world. Within corporate or company bonds, we focused on strong balance sheets. So we focused on investing in companies that would be more resilient in the face of economic worries. And we responded to a higher interest rate environment, as we've already discussed, within bond allocations in terms of the sensitivity to interest rates within the bonds. And overall, more neutral on equity sectors. So in times of uncertainty within markets, we made sure we had a more neutral or balanced or considered approach to equity markets on the whole. So in terms of the outlook overall, we do believe that we could see a more positive 2023, but I do think it's worth just zooming out a little bit and thinking about our longer term journey as investors overall. There's a lot going on in this particular chart, but I'm just showing you in the blue bar is the range of equities that you could get. The bonds is on beige, and then a 50-50 portfolio is in the light blue. On the left-hand side of this chart, you see the range of equities returns you could have got in any one calendar year since the middle of the last century would be a plus 61% down to a minus 43%. Bonds, a narrower range of plus 48 to minus 18, and the 50-50 portfolio in the middle. I won't go through all the bars in this particular slide, but you'll notice as you move from left to right, two things happen. Firstly, the range of returns narrows over time, so you have more certainty in what that outcome will be, and it also starts to skew upwards, so you are more likely to have a positive outcome the longer you hold your investment. And I do think that's very pertinent information and worth thinking about with 2022 to the forefront of our minds still. Similarly, I'm just showing you the volatility that you might see in equity markets in any one year. So for example, the red dot is showing you in any one year if you had bought at a high and sold at a low. So the worst possible return in any calendar year. However, the blue bar is showing you the actual calendar year return for any one year. So you'll notice that the red bar is always below the blue. What that tells us is that in times of stress, when things are very, very bad, when prices are low, it is worth keeping to your plan and holding your nerve and staying invested. Also, when we look at investing in the long term, many people on the call will be investing with Alan and the team at MBC via pension. And you can just see the power of compounding here, depending on whether you start putting money away at 25, 35, 45, or even 55. You can see the same amount of money invested with the same growth rate leads to wildly different returns and outcomes depending on when you're investing. So in summary, we do hope to see a brighter outlook for the year 2023. It was a poor 2022, but we see inflation expectations still holding the key. We expect inflation expectations to moderate, central banks to finishing their tightening cycle, and hopefully a brighter outlook for the global economy, which of course feeds into investment markets. On the right-hand side, I do think it's always worth remembering to stick to the long-term plan. I hopefully showed you a few tenets or principles of long-term investing. And if you'd like to discuss any of this further or talk about your financial plan, please do get in touch with Alan or anyone in the team in MBC Financial. Thank you very much and have a good day.